Yesterday in early trade, the euro dipped, weighed down by downbeat statistics on sentiment in the euro area and Germany. The indicators fell below analysts' estimates, thus putting pressure on Europe's single currency. In addition, traders digested data on German inflation. Annual inflation in the country came in at 6.4% in June, matching the preliminary results and analysts' predictions. On a monthly basis, Germany's inflation rose by 0.3%. Such a pretty stable situation allows the European Central Bank to lift interest rates further. Later on, demand for risky assets recovered, with the euro hitting a new one-month high in the Asian session. Speaking of the British pound, the situation was similar. The UK unemployment rate ticked up, while UK wages rose more than expected to a level that Bank of England Governor Andrew Bailey said is fueling inflation. Against this background, the regulator has no choice but to keep raising interest rates. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. All eyes will be on Andrew Bailey's speech and the Bank of England's financial stability report. The regulator's focus on a fight against rising inflation is likely to drive the pound sterling up until it becomes clear that the economy is plunging into a recession. Then the British currency is expected to dive. In addition, traders should pay attention to US inflation data. Notably, last week's labor market statistics showed a slowdown in US job growth. Thus, today's data on inflation can be decisive. Economists predict a 3.1% increase in consumer prices for the year ended in June, which would be a cool down from a 4% annual increase in May. In monthly terms, US consumer prices are forecast to have risen 0.3% in June, up from the 0.1% monthly increase seen a month ago. Furthermore, traders may take notice of the US core CPI, the Federal Reserve's preferred inflation goal. Economists expect core consumer prices to advance by 0.3% month-on-month in June. On an annual basis, the core CPI is estimated to have risen by 5.0% last month versus 5.3% in May. Higher core consumer prices will reinforce expectations of further interest rate hikes. Interestingly, there is a high probability that the Fed will lift the rate by 25 basis points at its next meeting scheduled for July 26. In autumn, the regulator is expected to deliver another quarter-point rate hike. Against this backdrop, the US dollar may claw back some of the losses incurred this week against both the euro and the British pound. From a technical point of view, the euro-dollar pair has hit a new one-month high. The level of 1.1016 acts as support. At this mark, I recommend going long in a case of a decline followed by a false breakout. In the event of a rebound, long positions can be considered at 1.0981. If the euro extends gains, a false breakout at 1.1053 will create a sell signal. Alternatively, going short will be relevant on a rebound at 1.1090 with a view to catching an intraday correction of 25-30 pips. Consolidation above 1.1053 in the first half of the day is unlikely to generate a strong buy signal, as it is not clear what inflation data will be. After all, going long at highs ahead of important statistics is too risky. Meanwhile, the British currency has run into 1.2659. If the price breaks above this level, driven by Andrew Bailey's remarks, sterling will most likely continue its bullish run. If the price overcomes 1.2966 and tests it from the top down, the volume of long positions will increase further. In this case, the pound-dollar pair is expected to edge higher to 1.3007 and probably 1.3046. At the level of 1.3046, traders are recommended to go short on a rebound. Short positions at 1.3007 and 1.2966 can be considered only amid a false breakout. In case of a surge in US inflation, sterling is likely to enter a bearish correction, sliding to 1.2927 and 1.2887. At the level of 1.2887, it would be a wise decision to open long positions on a rebound, counting on an intraday correction of 30-35 pips. Going long at 1.2927 will be relevant only amid a false breakout. Best of luck!